Gentlemen, thank you for joining me today. I want to ask first the question that was in the panel description. Are we in an AI bubble? Are AI startups overhyped or actually correctly valued?
Awesome. Well, thank you. It's great to be here. I think that this question gives me a little bit of cognitive dissonance and causes me to kind of challenge the premise of it slightly, because I do think that there's definitely a thing going on with valuations, and I think that it's kind of hard to justify a lot of what you're seeing, and I think that investors are very credulous of insane growth rates right now, especially for a bunch of specific AI categories. But at the same time, as a technologist, I feel like AI is going to be so transformative that the question of whether or not we'll capture enough value from the technology broadly is pretty obvious to me. It seems like yes, except that where that value gets captured and which companies and how you make sense of that, which I think is actually, as an early stage investor, it's a little bit easier for me to think through than perhaps where you're sitting in.
Yeah, no, I think Brett is right, and thank you, Blake, for the question. From our standpoint, we think it's unambiguous that we are in a AI bubble, and it's starting to leak. I think there's we come from the investment world as a firm. We're investor for 20 years in capital market and non-listed companies as well. And there's a say from John Templeton that is the most expensive forward is that this time is different. And I think you look at the valuation of the Magnificent Seven at the moment that are probably 35% of the S&P. These have a clear effect on what we're investing in, should it be very early stage or more early growth stage, because we end up paying very, very high multiple. And one thing I was sharing with you previously is that you look at deals like the one announced yesterday, where you have a SpaceX buying XAI from 1 trillion to 250 billion. Those are non-listed companies. They're pricing the deal the way they want. No one will be criticizing if it's the right valuation or not, because no one in capital markets is going to look at the numbers. So all of this has ripple effect on private market. And when it comes to early stage, I think the real question is how do you approach this new environment? How do you make sure you price the deal the right way and that you pass when you feel that it's just inappropriate in terms of valuation? But clearly, there's a lot of abnormality into this market right now.
Can you tell us about a deal that you passed on because you think this is overvalued, this is a victim of the hype cycle?
Well, I can tell you one that we passed on and one that we're currently doing now that is a crazy valuation and there's a rationale behind it. I mean, a company with 1 million of ARR that just raised in New York 15 million on 180 pre-money. Very exciting entrepreneur, something super cool in what they're building, but we just can't get comfortable on that. And at that valuation, that means we will make a return on a $2 billion exit. I have nothing that lead me to think that could be of interest or could have a fair chance of achieving that result. The counterpart of this is that we are in France at the moment looking at a deal that is led by Yann Lecomte. This is a company called AMI Lab, which is Advanced Machine Intelligence Lab. Yann was the head of the Meta Lab. He's with the Facebook group. Got into disagreement with Zuckerberg because he didn't thought that LLM was the way forward. It was more AGI. And there's some rumors that leak, but he's raising a small Series C of 500 million euro on 3 billion pre-money to prepare a larger one. Because it's AGI and that's something a bit differentiated, we're going to make a move in this one, and we're going to write a check on this one. But there's a rationale behind it. Yeah. But it's a tough market to price at the moment.
Yeah, and we've had, I guess it's early stage is sort of similar experience where you're, we invest mostly in seed rounds in San Francisco, so I think that a lot of the markets in the 20-ish million post, and then we do a lot of stuff out of the YC batches, which is double. Sometimes it gets double that. There's a bit of a premium, and then you'll see things that are 5x, at 100 for kind of no real reason, and that's where we take pause, especially, and we've seen companies where you're it's very clear that this technology is going to exist and be widespread, and so you kind of understand why other investors are pricing it the way that they are. but it often seems like it's also squarely on the roadmap of like all of the frontier labs, right? I think stuff like computer use is like a good example. There's a bunch of companies that are like very exciting, like kind of at the cutting edge relative to the frontier labs, but they're not necessarily. But you're like, surely OpenAI and Anthropic are building this, and so being overpriced and being in a very kind of red ocean, highly competitive field seem specifically poorly paired, because there's no, I mean, not that we play for downside protection, but there's no, like, the pref stack is like not your friend in those cases. But then I think at the same time, like, all valuation is like effectively an expected value calculation. And so if we do come across a company where we're like, you know, it's very hard to build this, especially if it's like very technically hard. It requires some deep technical unlock, but you know, like, you start to see more places where you're kind of like, the stars could align in like more, you know, hundreds of billion-dollar companies. So I guess it's like, there be dragons, right? Like, when I hide, like as I spoke a second ago, like, are now there's more credulity about these very, very enormous companies, and so you're able to justify other things, but you end up having to take it mostly on a case-by-case basis.
Do you ever tell someone, I think your startup is overhyped?
No. No, I mean, I try not. I think that I think there's a way to say that, right? It's kind of just like, I don't understand, like, I think that I don't fault entrepreneurs for leaning into hype. I think that that's something that, like, as someone who's previously an entrepreneur myself, I think that that is actually something a skilled entrepreneur will do with good reason. And so I don't really fault them for that. It's more just like, there's a lot of people doing what you're doing, and you're asking me to pay a lot for it, and it's just not legible to me who is going to win this category. It could be you, but like, as much as we like pride ourselves on finding conviction very, very early, sometimes if there's so much noise in the market, it's not necessarily the entrepreneur's fault, and I entirely like believe in, like, I don't fault them for believing that they're going to be the ones that transcend such a dynamic.
And are regional ecosystems in terms of talent, cloud access, regulatory clarity, are those influencing where you place your bets?
I think that's a really good question. It is certainly for us. So our firm, Whitestar, is probably investing 50% in North America, 35% in Europe, and the rest between MENA and Southeast Asia. Now in AI, what you're seeing as a very important aspect of it is a sovereignty of data. And I think if you look at a firm like ours, I happen to be Canadian and a British national. We have 20 nationality in our firms. We have some exposure to the US market, but we're very happy to have exposure to the European one, because there's a number of plays at the moment where you see that the companies will be funded locally, will be protected locally, and that creates some sort of barrier of entries for other competitors to come in. And that then create a moat that is quite specific for these companies. So looking at that, we have a play in the US, we have one in Canada, we're looking for one in Europe. I think in this region here, in the Middle East, there will have to be something emerging out of it. I think it's a bit more difficult to recruit the talent that we're having in China and in the US at the moment here, but things are changing. There's a lot of the diaspora that went to study in the US and abroad that is coming back, and I think events like the Web Summit, what you're seeing in other countries in the region, are also bringing that talent. And I think if the funding from the large investors, from the QIA to the one in the UAE to the one in Saudi Arabia and another region, is funding local champion around those sectors, it could clearly create some champions locally. So I think that's important to invest with geographical diversification from our standpoint.
Brett, you say you make mostly investments in San Francisco. What's the case for that's still the white hot center of AI?
Yeah, I think that there was a moment where I thought, you know, when I started the firm, it was definitely like San Francisco felt like the center of the world somewhat for technology startups. To me, I'm biased, but Californian. I had been, my startup was in San Francisco. But then, you know, it seemed like it was going to be a little bit more distributed through the pandemic, and then suddenly in the last few years, like, San Francisco's emphatically come back. There's just like a lot more activity, energy level. I just think that there's You know, I actually think that like AI is kind of fundamentally democratizing in terms of location because it's you know, it's one of the limiting factors in starting startups is like understanding what it's like to be a fast-moving startup and like learning. And now anyone who has a fast enough internet connection and access to the models has this way to tap into like that like knowledge zeitgeist. But I also at the same time, it's really hard to deny there's like the network density of San Francisco that makes for serendipity. And I think that serendipity is behind a lot of good things that happen for startups, just being in and around other smart people. And so I guess that would be the case for SF being, you know, a pretty large hub at the moment.
And I think I echo what Brett is saying. I think that the San Francisco and West Coast ecosystem is pretty unique on its own. I think it not only does it lead to a lot of phenomenal companies being created, but the US has a better way to monetize these investments. I think the liquidity of the stock market, like the NASDAQ and the US, is quite spectacular. And when you look at what we have in Europe and elsewhere, although there's some capital market, it's nowhere near what we're seeing in the US. So it's very difficult to monetize investments you're doing outside of the US. And as a result, you need to be very prudent on your entry points on these different markets. We have had some great success. I mean, UiPath is one. We have Datadog, that was a French company, but New York based. We have Revolut that is coming out. So there's some example, but all of these companies add to a US strategy. Now, with the current geopolitical environment, a number of us are having issues as to whether or not this is possible, because clearly a number of the non-US countries will have golden shares to prevent acquisition from large US companies, or maybe to block some ownership that will go into foreign hands. So that's one of the complexity we have that you don't have to deal with, would justify those crazy valuations you're seeing sometime compared to the one we're seeing in other markets. But with prudence, I think it's, and discipline, I think everyone will get out of it. And two interesting stats, I was having our team pulling some numbers. In 2000, for the one who started investing, let's say 1995, 1996, the stock market collapsed at the NASDAQ 80%. 80% collapse. Everyone thought that it would be staying at the right level, will be superb. 48% of the companies disappeared in the internet. 48%. Those are big, big numbers. Now, it's still led to the creation of Google, Amazon, a number of the big champions that we're seeing here. So no doubt there's something that is emerging that will be transformative, but I will not be surprised that we'll have a lot of cleaning in the industry in the next couple of years.
You said before that you think there will be a correction. Do you think it's millennium vibes out there? Do you think it's 2008 vibes? And where is the correction going to come from? I doubt it will come from startups. They're small and unlisted, but
I think there's two elements. I don't know where it comes from, and you never know when and how. But I can tell you that before 2030, I would suppose something will correct. And I'm not the only one saying this. Michael Burry, that predicted the collapse in 2008-9, has started shorting a number of these stocks. But there's two factors that I find quite worrying. There's among all those magnificent seven, the circularity of cash that is taking place between them. I'm buying you server time, I'm renting your cloud, you're investing in my GPU. All of this turn around, and it's the same company circulating the same money. And I think the numbers I read is around 320 billion of money that is turning around these companies. There's a moment where that music will stop and people will stop funding this, because those GPU, as an example, I mean, I think they have a depreciation life of 1 to 2 years. So you need to change this constantly, and you need to find the cash for that. So that's something that personally for me worry me a lot. The other thing is that at the moment everyone get excited on AI, but there's the wall of data that they call. I think by 2027, 100% of everything that was written by individuals, every books, every science project would have been put on those LLM models, and that creates a bit of a limitation of how much more you can create. And LLM, as we know, or as some of you know, is not creating stuff per se, cannot use images to think about what the future might be. That's AGI. And AGI, we're probably 5, 6, 7 years before we have a product coming in. So there's a number of money that's invested there that we're still having difficulty to see how it will produce cash. And if you cannot raise more capital and you cannot IPO and find capital in the stock market, then you're going to be in a very tricky situation. And I think those things are the ones that worry me the most when it comes to investing where we invest now.
What about you? Do you think there's going to be a correction?
I don't have as strong a view about like when and how, but I do think that it is some of these companies that need to find liquidity and like what liquidity level they find it at, that's probably what would trickle down through the rest of the system. And I do think it is an interesting point that a lot of the higher valuations are still in private deals, So until you see the full scope of like how the public market reacts, it won't trickle down.
And with those enormous valuations, both public and private, how does that affect what you do, especially so early on in the process? How do you do any due diligence if the biggest, these vast, almost totally improbable projections could come true?
Yeah, I mean, it is a little bit distant. At times it feels a little bit distant from my day-to-day. I think that there's a band when you're constructing, you have a little bit more tolerance when you're constructing an early stage portfolio in terms of like entry position, and there's a band that I think that makes sense for our firm, and we try to not stray too outside of it unless we have a very strong belief about the type of outcome that can be created. I think that the companies we're investing in today are getting liquidity like well beyond this market cycle, right? And so so trying to play too much into the timing of it when you're doing seed and pre-seed checks doesn't make a lot of sense. And the pricing is going to be is a market factor, and so where you're ultimately judged against your peers, and if everyone's paying to the same pricing regime for pre-seed and seed deals, it can be as important just to be in the right deals as anything else in a parallel industry.
And on our end, I mean, we're going to be just a bit later stage than what Brett is doing. There's a number of features. I mean, liquidation preference, weighted average ratchets. There's a number of things that you need to put into your deal to protect yourself. And what we're seeing now, the high valuation is not new. If you just go back in 21, 22, we were talking about our previous vintage. We all paid too much in digital health. During COVID, digital health was the cool thing. You were paying 20, 25 time AR multiple, and it corrected to 5 to 6 times. Now, anyone that was in safe notes with no protection had some challenge. If you had weighted average ratchet, if you had liquidation preference, you had an ability to protect yourself, a number of us were able to recorrect some of the mistakes through that. And that's possible in private market to do if it's done the right way. And I think that's the type of feature we have now. And when it goes super well, you don't need to use it. And otherwise, it's just a good partnership with the founders.
And which is why also to think when I talk to founders, especially the early stage ones, don't like paying too much attention to the headline number, your round prices.
Absolutely.
And treating that as if it's success in its own right is very, very risky because the pref, like I said earlier, pref stock is not your friend in some of these market dynamics.
Yeah, absolutely.
I think that's a good note to end on. Thank you, everyone, for coming to watch.
Thank you.
Thank you.